Hello my friends, it's Robert Miner with Dynamic Traders Group with a brief video that we do every couple of weeks for our YouTube subscribers and Twitter followers. I'm going to talk about the S&P and the election cycle today. I've really just written a very comprehensive reference book on the election cycle and the S&P, and the reason I want to talk about it today is that maybe not in the next few days, but within a couple, 3 weeks, I think there's going to be one of the best setups within the election cycle. And I'm going to show you some of the information about that and what to look for. This is a setup that since 1952, there's only been one losing year, and that was by less than 1%. So it's really, really strongly biased in your favor, and particularly when a market has a technical setup that I'm going to talk to you about in a minute. So if you're interested in the stock indexes, our trading stocks, or stock index ETFs, boy, this is going to be a video for you, and I'll have you prepared for what might be one of the best trade setups you'll have this year. So just before we get started, I'm just going to give you a little plug on my book, is that it's the definitive guide to the U.S. election cycle and stock market trends. It's available on Amazon, has a lot of material in it. It will be a really go-to reference guide for you if you trade stocks or the stock indexes. So go to Amazon, check it out. Let's take a look at where we're at right now within this cycle. I've recently, just in the past week, done two what we call DT Big Picture Report updates. That's where I look at the intermediate and longer term cycles and trends and probable position for various markets. I did one on Bitcoin and the halving, and that's really has some interesting information on what is likely the outcome in the next few weeks to few months following the halving that was last week. And I did one on the election year cycle as well. So some of the material we're going to talk about now comes out of the election year cycle update I did for our DT Report subscribers. Of course, that report had a lot more information in it than what I'm going to give you, but I'm going to give you enough here. I'm not holding anything back. You're getting some solid information that'll help you make a specific trade decision in the weeks ahead. So let's take a look at this first chart that I have here on the right. And this is just your very typical chart where we look at the averages of all of the election years since 1952. That's the dark black line. And then the averages of all the election years since 1984. That's the gray line. You can see they're basically the same shape. The only difference is the average of all the years since 1984, all of the election years, has been relatively weaker than it was when we include the years prior to 1984. And the red line is 2024 up to just the past week. So of course we had a really strong first quarter in 2024. The average for the first quarter, that's this section right in here, January through March, has been basically flat to even net bearish. So the details, I don't have the details here, but it's basically about half of the years, election years since 1952, have had positive first quarters, and about half have had negative first quarters. So tells us that there's actually no bias, directional bias for the first quarter in an election year. So while the average is sideways, about half of the years had a pretty strong first quarter. Thing is, about half of the years had a pretty negative first quarter. You average them out as sideways. By the way, no one, and I mean absolutely no one who successfully trades would make a trading decision based on the averages of anything. But the averages are a good place to start. And if we look at the average, and this again is just election years, if we look at the average for the election years since 1952 and 1984, the obvious, what looks like a directional bias, would be right in the middle 2 quarters of the year, the second, third quarter, which have been net bullish, at least the averages have been. But we need to take another little look with some additional data for this time period to see if there's actually a seasonal bias that we can use to make a specific trade decision. So let's do that. So this chart is just of the March, beginning in March through September period of the election years. And let me tell you what these averages are, because it's kind of interesting. Is this blue line, this bottom line, that's the average of all of the election years since 1952. And you can see that as we looked before, when we saw the entire year, the first part of the year is usually fairly negative. See, this is below zero for the first part of the year, on average anyway. We can also see this distinct dip into the middle of May. Let's keep that in mind. What are these other two averages? Well, the one that's in gray is the average of all of those years, all years when there was an incumbent president running for re-election. Of course, that's the situation this year in the United States, whether it was a Democrat or Republican. So that line takes about the same shape as the line for all of the years, but it's definitely at a higher level. Meaning that there's a much stronger return for those years, typically at least on average, that had an incumbent presidency that was running, first-term president running for the second year. And this orange line right above it, also pretty much the same shape as the trends of the other two lines, and pretty much the same return as the incumbent line. This is the line just of those years with a first-term Democrat running for re-election. So again, those years of a Democratic years or just incumbent years, they had much stronger returns than in general when we add in all election years. So the reason that's important is this year is a first-term Democrat running for re-election this year. So we look at these averages and say typically that's a pretty bullish period from around the spring into the summer. So I'm only showing the spring through the summer in this chart. So that's a wake-up call that we might want to look at some other data. And that's the data that's going to be really interesting for you. Let's take a look at it now. So in the report that I did, the more comprehensive one for our subscribers, I had the tables and the details. I'm going to give you the summary of what to look for. So here's just two key pieces of information from the election year study from the spring until through the end of the summer. Number one, we've already seen the summer low is usually made around the second half of May to the first half of June. So that summer low probably hasn't been made yet. And it sort of implies that the S&P is likely to be sideways to down into the second half of May. Now I'm recording this on April 25th, so it's we're getting near the end of April. So that would indicate that we've probably got at least 2 to 3 weeks of the S&P being sideways to down. At least that's based on the averages of election years. And we'll also take a look at the technical position in a minute. Now let's take a look at number two, because here's where the piece of information is you want to remember. In every election year, and I underline that because it's really important, in every election year when the first quarter was strongly bullish, which it was in 2024, the S&P traded above the March high by September 20th, except one year. That was in the year 2000. And in 2000, the summer high came within just 7 points of the March high by September 20th. Why is this really important? Now, I don't know what the S&P is going to do over the next few weeks or even few months, but if the S&P happens to be sideways to down for the next few weeks, what we know is the bias is overwhelmingly strong and bullish that before September 20th, the S&P will then trade above the March high. And we know the March high so far is the high for the year. So what that tells us is more than likely if we see the S&P sideways to down in the next few weeks, that it's making a correction. And we want to focus on identifying when the S&P would get in a position to complete the correction. Let's take a look at the technical position and a chart of the S&P right up through, well, a couple days ago I captured this chart. So this is the S&P closes coming up from the October 2023 low. And of course it's been strongly down since then. And I don't even have the last couple of days on here, which has continued its decline over the last couple of days. What is the probability or the strong possibility of the next few weeks? Well, based on just not the election year, but just our time factors, is that typically if the S&P is making a correction against this advance, which I've detailed in our reports that it's in a position to do that, is a correction would not be complete prior to May 23rd, the 38% time retracement. Doesn't that fit almost exactly in with the average and typical correction into the second half of May to early June based on the election year cycle? Well, it does. I don't know if it's going to do that, but when they both line up together, that's pretty important to know. It's also important to know that the election year cycle strongly suggests if the S&P is sideways to down into that second half of May or even into June, is that before September 20th, the S&P is likely then to advance to above the March high. So you can see why it could be really important that if the S&P is sideways to down over the next few weeks, is to identify when it's in a position to complete a correction. That's what I'll be focusing on the next few weeks and focusing on with our DT report subscribers. So keep this information in mind. It could set up potentially for a really great trade here in the next few weeks. Well, that's it for today, my friends. Everybody take care. I'll be back with you in a couple of weeks. Stay safe, stay healthy, have some fun. It's Robert Miner over and out for now.